On Wall Street, the worst moments rarely announce themselves with a trumpet. They begin as a feeling that something is slightly wrong beneath numbers that still look respectable. The screens are green often enough to keep hope alive. The headlines still talk about resilience. The strategists still say the consumer is fine, the labor market is holding, corporate America is adapting, innovation is unstoppable, and the market is only climbing a wall of worry the way it always does. But underneath all that language, something much more primitive begins to happen. The room starts to lose oxygen. That is the image I want fixed in your mind. Because if you understand that image, you will understand the 2026 liquidity trap better than most professionals talking about it on television. A market does not die because price looks ugly on a chart. A market dies because the oxygen leaves the room, buyers become selective, credit becomes expensive, refinancing becomes punishment. Weak hands stop being weak hands and become forced sellers. Then everybody discovers at once that an asset is not worth what they wrote down when money was easy. It is only worth what a real buyer can pay when cash matters more than optimism. I learned that lesson long before most of the people speaking confidently about the current market were old enough to place a trade. I have sat through enough cycles to know that every bubble creates its own vocabulary to explain why gravity no longer applies. I heard it in the late 80s. I heard it in the internet boom. I heard it before the mortgage machine broke itself in 2008. I heard it again when zero rates convinced a generation that duration did not matter, debt did not matter, valuation did not matter, and a central bank could suspend consequence forever. It never can. It can delay consequence. That is different. And delayed consequence is often more violent, not less, because people build larger habits of carelessness on top of the delay. So when I look at 2026, I do not begin with the index level. I do not begin with whether the NASDAQ is close to a high or whether the SP still looks calm from 30,000 feet. I begin with the plumbing. I begin with the oxygen. How much liquidity is entering the room? How much is leaving it? Who needs refinancing? Who needs bids? Who is pretending to be solvent only because markets have not forced a mark yet? Who is counting on the Fed to ride in on a white horse, even though the horse is older, slower, and carrying far less authority than it did in the last rescue? Once you begin there, the picture gets uncomfortably clear. The setup in front of us is not a simple overvaluation story. It is not just an earnings story. It is not even just a rate story. It is a structure story. For 15 years, the system learned the same bad habit: borrow cheaply, extend duration, pay too much for uncertain cash flow, assume the discount rate will always fall again, assume the rescue will always come, assume that time itself has become easier because money has become cheaper. That entire habit structure was built in an artificial climate. If I build a house in the tropics, I build one way. If I build a house in the Arctic, I build another. America spent a decade and a half building portfolios, companies, financing models, pension assumptions, private equity structures, and government deficits for a tropical climate of easy money. Now the weather has changed and everybody is surprised that the walls are cracking. They should not be surprised. Arithmetic is not emotional. Arithmetic does not care about narratives. Arithmetic does not care about whether a politician needs lower rates or whether an equity strategist wants one more year of upside. In a momentum trade, arithmetic simply totals the bill, and the bill is now staggering. When I compare the world before the 2008 crisis to the world we have today, I do not feel reassured by the size of the institutions. I feel alarmed by the size of the mismatch. Before the great financial crisis, the Federal Reserve had room to act in the debt burden, while Sirius still sat in a range where the rescue mechanisms looked powerful relative to the problem. Today, the Federal Reserve still looks enormous on paper, but the debt tower standing in front of it is far larger. The annual interest expense is swallowing oxygen every quarter, and the political room to impose pain is far narrower than anything Paul Volcker would have tolerated. That matters more than people realize. A central bank can save almost any system once. What it cannot do is save a system indefinitely while preserving its own credibility, the purchasing power of the currency, and the confidence of the bond market at the same time. At some point, one of those three gives way. That is the trap. Most people think a liquidity trap is a dramatic event that begins on a Friday and terrifies them by Monday morning. That is not how it really works. A real liquidity trap begins invisibly. It begins while the mood is still decent. It begins while the equity benchmark still flatters the complacent. It begins while financial television can still say the economy remains resilient, and investors should use weakness as an opportunity. The trap is already active when hope is still loud. I think about it in three stages. First comes what I call the oxygen illusion. That was the period when rates rose, everyone predicted instant pain, and yet markets kept levitating. People concluded that high rates did not matter. They concluded that the old rules were gone again. What they missed was that liquidity was still being injected through another pipe. The Treasury was running down balances, cash was still moving through the system, and the market was responding to the oxygen, not the rhetoric. That is why a great many sensible people looked foolish for being early. The market was still being fed. Then comes the Treasury vacuum. That is where we are now. The spare oxygen tank is nearly gone. The government has to borrow in size into a market that is already tired. The Fed is not genuinely easing into clean disinflation. It is navigating a debt burden that punishes every month of higher rates, while inflation remains just alive enough to keep a full rescue politically and institutionally dangerous. The result is a quiet suction, more issuance, more refinancing strain, more pressure on the long end, more competition for capital, more hidden stress in places that lived on cheap funding. That suction is easy to ignore because the broad market can still look composed. But underneath the surface, the stress shows up where it always shows up first. Breath gets thinner, smaller companies stop participating, credit grows more selective. Secondary liquidity becomes less forgiving. Things that used to trade by appointment still trade, but at worst terms, bid-ask spreads widen where nobody but professionals are paying attention. Private marks become fantasies waiting for a banker or an auditor to force honesty. That is why I do not care when someone tells me the index is still close to the highs. Surface calm is not evidence of internal health. In a true liquidity squeeze, the surface often remains calm right up until the interior fractures become too large to hide. Then comes the forced seller cascade. That is the phase most people think is the beginning. It is not, it is merely the moment the hidden arithmetic becomes public. A regional bank goes from concern to event. A fund gates redemptions, a deal that should have priced does not price. A refinancing that was assumed becomes punitive or impossible. Credit spreads widen faster than the optimists can update their language. Then the system discovers that a great many owners are not actually owners at all. They are renters of market stability. The moment stability gets expensive, they must sell. That is what I mean when I say the room loses oxygen. It does not mean everyone dies. It means everyone who depended on easy breathing has to fight for air at the same time. The reason I believe this setup is more dangerous than 2008 is not that every individual piece is more shocking. It is that the constraints on the response are tighter. In prior crises, the Federal Reserve had one great superpower. It could crush the discount rate, flood the system with liquidity, and rely on the market to believe the cure, even if the disease had not fully cleared. It could do that because inflation was dormant enough and fiscal excess had not yet metastasized into the kind of arithmetic we face. Now, today, the Fed faces a credibility trap. If it keeps policy restrictive, it intensifies pressure on a debt pyramid that was never built for honest capital costs. If it rushes to the rescue, it risks reigniting the inflation psychology that savers have already tasted and that bond investors are no longer willing to dismiss as temporary theater. That means the old rescue still exists, but the market's willingness to treat it as magic has weakened. That changes everything. Because a rescue that no longer inspires confidence does not stop a panic the way it used to. It can even deepen the panic if investors interpret it as proof that the institution itself has become trapped. Now, let me tell you exactly how I think about positioning in a climate like this. I do not position by emotion. I do not position by prophecy. I position by function. Every dollar in my portfolio has a job that matters. A lot of people think diversification means collecting many tickers. That is not diversification. That is decoration, unless each position serves a structurally distinct purpose when the weather changes. My first bucket is what I call optionality reserve. That is cash and treasury bills. Not because cash is exciting, not because I suddenly forgot that inflation exists. Cash in a late cycle market is not there to make you feel clever. It is there to keep you alive, liquid, and dangerous when other people become helpless. When I hold a meaningful reserve in short bills, I am not saying I refuse to invest. I am saying I refuse to become a forced seller. I refuse to let a drawdown turn me into a passenger. I refuse to arrive at the shopping season of a panic with empty hands. That distinction is enormous. You do not hold cash because you are bearish by temperament. You hold it because liquidity is power. And in a crash, liquidity is not just power. It is the power that turns into every other asset at a discount. The second bucket is controlled offense against fragility. That means short exposure aimed not at the whole world indiscriminately, but at the places most dependent on abundant liquidity. Forgiving multiples and refinancing dreams. Zombie businesses, fragile real estate structures, institutions pretending marks are still real because nobody has forced a sale yet. Index exposure in the most duration, sensitive corners of growth, where too many people still price tomorrow like money is free. I do not short because I enjoy negativity. I short because when oxygen leaves the room, fragility has a price. The market eventually charges it. The third bucket is monetary insurance with torque, that is precious metals, and when I want amplification, miners. People misunderstand gold because they insist on discussing it as though it must justify itself every week. Gold is not there to entertain you every week. Gold is there for the moment the market decides that paper promises, fiscal discipline, and central bank credibility no longer belong in the same sentence. If I think the system is approaching a point where authorities will be forced toward easier money with weaker credibility, then I want exposure to something no committee can print. And if I can buy productive businesses that mine that monetary insurance with operating leverage, I understand that the upside can be asymmetrical once the system turns from squeezing liquidity to manufacturing it. The fourth bucket is real-world scarcity energy. You can fabricate stories, you can fabricate adjusted earnings, you can fabricate soft landing narratives. You cannot fabricate barrels, not for long, not when supply is constrained. Geopolitics are unstable. And the easiest source of relief for policymakers is a weaker currency. Energy is not simply a commodity position in that environment. It is an inflation transmission hedge and a reminder that the physical world still gets a vote. The fifth bucket is what I call the everyday toll booths, defensive consumer staples, businesses that sell what ordinary life still demands when confidence collapses: soap, toothpaste. Basic medicine, cleaning products, household necessities, these are not glamorous companies. Good. Glamour is expensive. I want businesses with pricing power, cash flow, and the quiet dignity of necessity. If hard times come, people may postpone a luxury purchase. They do not postpone brushing their teeth. That is a different kind of durability. It matters. Notice what I am not doing. I am not building a portfolio designed to win a popularity contest in the final stretch of a momentum cycle. I am not stuffing money into the most crowded growth stories because they worked last year. I am not pretending that 7 mega-cap names are diversification just because the index committee says so. I am not using leverage. I am not outsourcing my thinking to the idea that the Fed will always save the day in a way that preserves both valuations and currency quality. That entire habit belongs to the world that is ending, and there is an identity shift every serious investor must make. Now, you must stop thinking like a spectator and start thinking like a treasurer. A spectator asks, what is hot? A treasurer asks, what survives? What hedges? What buys time? What owns real pricing power? What gives me optionality? What lets me act when the crowd is frozen? That shift in identity is where most fortunes are quietly saved long before they are dramatically built. But even a good portfolio is useless without triggers. So I always reduce the noise to a few numbers that matter. The first signal I watch is the 10-year yield. If the long end climbs through a level that tells me the bond market is demanding a true risk premium from the United States government and then holds it, I stop treating it like noise. That is not just a number. It is the market's way of saying the rent on the debt. Spiral is rising. The second signal is the regional bank complex. People who lived through enough crises know that small and regional institutions are often where hidden marks become visible first. When a broad measure of that space breaks badly, it tells me the soft tissue of the credit system is tearing. The third signal is credit spreads. Not speeches, not headlines, not soothing language spreads. When high-yield financing begins demanding a real penalty over safer credit, it tells you fear is leaving theory and entering price. Those three numbers together tell me more about whether the break has arrived than 10 hours of televised commentary, and I do not simply sit with those signals. I map them to phases. In the current phase, patience matters more than bravado. I hold the 5 buckets. I let cash earn. I let the fragile parts of the market reveal themselves. I do not chase. I do not flinch, because an index makes a new high-late cycle highs are often invitations to ego. I do not accept the invitation. When the signals begin to trigger together, I become more aggressive on the offense against fragility. That is not because I am suddenly emotional. It is because the market has finally started confessing. Once confession begins, forced selling often outruns imagination. Then comes the hardest phase psychologically, the one that separates operators from storytellers. You must cover offense and begin buying quality while the world still feels broken. You do not buy because you feel good. You buy because the authorities have crossed from talking about relief to delivering it, because the arithmetic of repression or reflation has become unavoidable, and because great businesses are now being offered at prices only panic could create. That is how the cycle completes. Defense becomes offense, optionality becomes ownership, patience becomes compounding, and then when the dust truly settles, you rotate from fortress mode back into accumulation mode, not blindly, not because everything is wonderful again, but because the shopping season of fear has done its work. I need to say something else, because this destroys more investors than bad analysis ever will. Your ego can bankrupt you faster than the market. I have watched brilliant men become attached to being right in public. They identified a danger too early, got punished by timing, and then clung to the position even after the evidence shifted because admitting adjustment felt like humiliation. That is, childish markets do not reward your autobiography. They reward your adaptability. When facts change, I change my position. I do not owe the market consistency of ego. I owe myself disciplined interpretation of evidence. That means if the system genuinely changes, if the Fed or the Treasury or the inflation backdrop or the liquidity pipe changes in a way that invalidates my thesis, I will move. Not because I became weaker, because I remain serious. You must learn that strong views are useful. Marrying them is fatal. Now, I want you to understand the choice in front of you. Most people will do what they always do near the end of a cycle. They will look at a market that still appears functional and assume functionality means health. They will treat the absence of a visible crash as proof that concern was overdone. They will keep reaching. They will ignore the oxygen. They will confuse price persistence with structural soundness. Then when the break arrives, they will act as though it came from nowhere. It did not come from nowhere. It came from arithmetic they refused to respect. It came from refinancing risk they did not study. It came from bond market skepticism they never learned to read. It came from years of treating easy money as a law of nature instead of an emergency setting on the machine. The alternative is more boring and much more profitable over a full cycle. You can accept that the liquidity trap is not a future rumor. It is a present structure. You can accept that calm headlines do not refill the room with oxygen. You can accept that your job now is not to squeeze the final ounce of pleasure from a mature bull move. Your job is to arrive intact, liquid, and psychologically ready for the repricing that always punishes the complacent and rewards the prepared. That is the contract. You either sign it voluntarily now or the market signs it for you later in red ink. If you remain a spectator, you will keep asking whether the market looks fine. If you become a treasurer, you will ask a better question: how much oxygen is left in the room, and what have I done while it is still possible to move calmly? That is the real question of 2026. And the investor who answers it honestly before the crowd does is the investor who still has cash, nerve, and choice. When panic turns great assets into bargains, everybody else will call that luck. It is not luck, it is structure, patience, and the refusal to confuse a quiet room with a safe one. And let me make the operational blueprint even plainer, because vague conviction is what gets people hurt. If yields lurch higher and hold, I do not argue with the bond market. I assume capital has become more expensive than the stock market crowd wants to admit. If regional lenders begin breaking down, I do not tell myself that my favorite large cap can ignore the plumbing. Credit stress always matters more than the equity crowd wants to believe. If spreads blow out, I do not sit around waiting for a talking head to use the word contagion. By the time the language becomes dramatic, the pricing has usually already become merciless. That is the discipline. Respect the sequence before the sequence forces respect out of you. A great many investors think courage means holding on no matter what. Sometimes courage means holding, sometimes courage means cutting. Sometimes courage means sitting in bills while strangers call you timid. Sometimes courage means shorting fragility while the crowd still believes the party is only getting started. And sometimes courage means buying wonderful businesses when every emotion in your body wants the comfort of waiting for one more week, one more headline, one more piece of proof. But the market does not pay you for emotional comfort. It pays you for being early enough to act and disciplined enough to keep acting when the room gets noisy. So here is the test I would leave you with. If the room lost half its oxygen in the next 6 months, would your portfolio become more frightened than you are, or would it become more powerful? Would it force you to sell, or would it hand you the cash and optionality to buy? Would you wake up hoping for reassurance from the Fed, or would you already own the assets? The hedges and the patience that make reassurance unnecessary, that is the dividing line. You are either built for the squeeze or you are built to be squeezed. And in a year like 2026, that difference will not show up as a philosophical difference. It will show up in your net worth, your peace of mind, and the price at which you either surrendered or stepped forward,